Kulkarni
Good
sir.
evening. Myself CMA Vinayak Kulkarni and CMA Ashish Bhavsar welcome you all for the series of webinar on income tax. Today is the second session of the series on income tax, and today's topic is income from profit and gain of business or profession. Now, I will request CMA Ashish Bhavsar to take it forward.
दिलीप ये शेयर क्यों
Ashish, you are
Ashish, you
muted.
are on mute. Ashish, you are on mute.
ये शेयर क्यों नहीं हो रहा?
Thank you. Thank you, Kulkarni sir. Once I welcome you all for this today's second session. We recognize the presence of CMA Dr. Ashish Thatte, Chairman of Direct Taxation Committee of our institute. CMA Sriram Mahakaliwal sir, Chairman WRC. In continuation with yesterday's our session on income from salary, Sriram Mahakali sir wants to add some thoughts on that. So first of all, Sriram, we hear Sriram sir, and then we move to the speaker, the CMA Amit Sahni. So Sriram sir, over to you.
Is my screen visible, sir?
Yes, sir.
Yes, sir.
Some computation is getting reflected over it.
Yes, yes, sir.
Since yesterday we deliberated on the topic income from salary, I thought it prudent to share with you the standard computation for the salaried class people or the people who derive income not only from the salary but through all the other heads of income, and how our computation as well as the preparation of the return should be exhaustive enough so that we can reduce the minimum chances of the mismatch of TDS, mismatch of say incomes or any other related issues with respect to the regular 143.1 summary assessment, which is regularly, if your return is complete in all respect, the assessees get the 143.1 assessment summary. So accordingly, I have one example wherein the employee is working with a banking company. He is deriving from salary. So I have shown his salary for this relates to the period 21-22. The gross salary is 48 lakhs 20,316. And apart from that, he is receiving perquisites in by way of granting him of ESOP, which is employee stock option, amounting to rupees 16 lakhs 51,716. So actually the amount of ESOP is more, but this is the differential price in between the granted price as well as the market rate as on date of that particular bank's share, and it amounts to 16. That difference amounts to 16 lakhs 51,716. Hence, it is treated as a perquisites within the meaning of or under the section 17(2). So that way, his gross taxable salary comes out to 64 lakhs 72,032. Since he is adopting the old regime of taxation, we have taken the standard deduction of rupees 50,000 as well as the professional tax of 2,500, which provides him the deduction under section 16, and accordingly his taxable salary is 64 lakhs 19,532. Apart from that, he is having his own self-occupied house property for which he has borrowed the loan from the bank, and he is paying the interest on that borrowed capital for the construction of house property, and that amount of interest is 1,34,095. So since it is allowable under section 24 of the Income Tax Act under the head income from house property as a deduction, the same is shown as a negative income since the annual value being SOP is nil, and his interest on borrowed capital is 1,34,096. Hence, the house property income is showing a negative of 1,34,095, which will be adjusted against the his salary income of 64 lakhs 19,532. Apart from that, he is also he has during the year sold the shares in the capital market, and accordingly he has also he is in receipt of the and he has earned the long-term capital gain as well as short-term capital gain, for which we have prepared a separate calculation sheet which is below this page itself, at the bottom of this page, wherein you will find this is statement of capital gain for short-term scripts for short-term earnings under section 111A, wherein we have listed the securities which he has sold, where it reflects about sale date, sale consideration, purchase date, purchase cost, improvement cost, and other expenses incidental to the transfer or the sale of these shares. So the gain or loss is reflected in the last column, which we have shown separately by way of statement of short-term capital gain. And likewise, he has sold 9 scripts, resulting in short-term capital gain of total 1,53,603. As per this calculation, we have included this amount here, which is taxable short-term capital gain falling under section 111A 153603, which matches with the computation of the short-term capital gain. Apart from that, he has also sold the long-term capital. He has also sold his old stock of shares, which has resulted in long-term capital gain under section 112A, which is also reflected in the return, and the cost of it is say 75,71,900 sale consideration, and the purchase cost of it was 49,65,000. So accordingly, apart from that, he has also incurred some expenses of 55,040, which is also eligible for deduction, and the net gain or loss from this sale of long-term capital script is 25,51,860. So this also we have included in our long-term capital gain. Accordingly, the total capital gain is that comes out to it is 27,05463. Since, as we all of us know, that the capital gain is taxed by way of special rate of taxation, and it doesn't taxed at the rate at the normal rates. So it carries the different special rates. Accordingly, their tax calculation is also provided in the top sheet. Apart from that, he is also getting income from other sources, that is the interest on savings banks. We have tried to include each and every bank account of the assessee which he is having, and which we have reflected all those accounts in his income tax return, where as a additional information in while filing the return itself. All the 3 accounts are incorporated in the income tax return, and the return and the interest earned on these saving banks is also reflected in the return, which comes out to 38,180. Apart from that, he is also deriving income from interest on bank FDR. That is one by one we have taken. This is interest on HDFC Bank Limited, interest on FDR MIS with post office, interest on post office RD. I think this was actually for the last year, and since this year he has not earned any interest. Since generally what happens, the RD gets mature, you get the interest in totality in the 1 year itself, in the year in which you are filing the return. But as a prudent norm, I always advise my client to book the RD interest in the year on an accrual basis, in the year in which you receive your interest get accrued. So since the total interest was 29,302, less shown in earlier years 18176 from assessment year 18 till 21-22. So that way this interest we have already incorporated, and hence there is no need to show the interest on RD. Apart from that, interest on HDFC Bank Limited FDR is also shown. Interest on ICICI Bank is also shown. Shriram City Union Bank is also shown. RD account with his HDFC Bank is also shown. That way, this total income from the interest on FDR and other RD accounts comes out to rupees 5,36,274. He is also deriving other income in the form of dividend. He is earning since last 2 years. The dividend earlier was getting exempt in the hands of the recipient, but since last 2 years it has been made mandatory that whosoever receives the dividend amount, it will be taxable in his hands. Accordingly, that we have also incorporated. So these are all the elements of income constitute building your total taxable income. And after you constitute your total taxable income, you need to assess your deductions which are eligible to be deducted from the gross total income. So accordingly, his contributions in the provident fund, his LIC premium payments, his repayment of housing loans, tuition fees, etc. Although the maximum permissible limit is 1,50,000, we have reflected all the amounts which during the year which he has paid to show the department about the expenditures, the cash outflow the assessee is doing towards the ATC investments. Accordingly, eligible deduction is 1,50,000, and that way we have claimed in this return. Similarly, is also having mediclaim policy for which he is paying payment of say 71,100. Since in this case, I have suggested the assessee that he should rather making a payment, since his only allowable expenditure is 25,000. So in 71,100, he should also incorporate the names of his parents so that he can get the higher amount of deduction under section 80D. Apart from that, he is also eligible for deduction under section 80 TTA for interest on deposits in saving account. His total interest earned was 31,000. For these deductions, if you go through the summary of this at the top sheet, you will find these are all my income elements, which constitutes 96,47,850 less deductions, which we have just now seen. They are 1,85,000 coming to 94,62,850, including the special income of capital gains as well as my normal income of salary and income from other source. So that way we have made the tax calculations for normal and for special rates. So normal income is 67,57,387, and for special rate of capital gain income it is 27,05,463. So that way here you will find the tax calculations also. This type of computations we prepare while filing the return for the assessee. So this is quite an exhaustive and well prepared working return. So that way, anytime if there is any query from the department, you can easily rather give the explanation to whatever queries they have raised. Accordingly, the total taxation for the normal income comes out to rupees 18,39,716, and for special rate of taxation under section 111A, that is short-term capital gain, it is 23,040, and for long-term capital gain it is 2,45,186. In all, we are having the tax liability of 21 lakhs something 7,000, on which, being his income has exceeded over and above the basic limit of 50 lakhs, is eligible for this additional surcharge, which is also 10%, on which is charged, for which we have made the provision of 2,10,794 as surcharge payment. In totality, my tax liability is 23,18,736 prior to levying of health and education cess, which is 4%. In totality, my total tax liability, including the health and education cess, is 24,11,000, out of which my TDS, tax deducted at source, is 19,95,000. And after that, I have also paid the advance tax of 1,50,000. So out of 4,15,000, if you deduct 1,15,000, balance is balance tax payable is my liability, on which I am supposed to pay the additional interest also, since the as per the provisions of advance tax, you need to pay the interest after your outstanding payment exceeds certain amount. So that way we have made the self-assessment tax payment of 2,89,880. So this is only a sort of a sample specimen of salary with all other heads of income computation. I will request all the members to go for such type of preparing the return. And once you prepare such type of make such type of computations, it makes you very much easier while filing your regular income tax return. Although if you are filing through the online utility mode of the department or through the some tailor-made softwares available in the markets, my one more suggestion to members will be that if while calculating all these, you need to rather analyze what are the incomes which are subjected to TDS, and that incomes reflected in the 26AS have all been incorporated in your return itself. Because if your incorporated income is less than the reflected income in the 26AS, then certainly there will be query from the department and you will be asked to pay the additional amount of income tax on that. So I will be requesting all the members to kindly prepare such type of return, such type of computation prior to filing your online return. Thank you so much for giving me an opportunity. Vinayak sir, you can continue. Vinayak sir? Vinayak sir?
Yes, sir.
Sir,
हो गया है मेरा?
Okay.
हो गया
Thank
ना?
you, Sriram
दिख
sir.
रहा था ना? Hello?
Yes, yes, sir. अभी भी दिख रहा है.
Hello.
Screen is visible.
हाँ, ठीक है.
हाँ.
Okay. And whether my voice was also reaching to all of you, no?
you are completed, sir?
Yes,
Yes,
yes.
yes. I have.
Yes.
Yes, your voice was reaching. Yes.
Huh?
So, yes, Gulkarni sir, Sriram sir has already completed. Thank you, Sriram sir. Now with us, CMA Dr. Ashish Thatte sir.
Sir, you please close your presentation. Ashish, you can.
Yes,
Ashish
thank you so
Bhavsar.
much. Thank you so much, Kulkarni sir and Ashish Bhavsar ji. Very enlightening speech by Sri Ram sir also for the various computation which he had shown. So I'm sure that all our participants are enjoying the deliberations which had happened even yesterday and which are going to happen today. Of course, my best wishes to our regional council team who has taken up this initiative, led by Sriram Bankaliwar sir, and of course, Vinayak Kulkarni ji and Ashish Bhavsar from Ahmedabad. So my best wishes to all of you. I just had a session today morning on the new, this is the old regime and new regime with Thane chapter of company secretaries. And it was very interesting, the way the new regime and old regime has been designed by the our honorable finance minister in the finance bill. So definitely, I'm sure that our team will consider that also somewhere in future, or it might have been done earlier also. I'm not aware about it. So my best wishes to all of you. Thank you so much. Kulkarni sir, back to you.
Thank you, Ashish.
Thank you, Ashish. Dr. Ashish Thatte. Now I will request Ashish Bhavsar to take the session forward.
So thank you very much, Gulkarni sir. Now, today we have a session on the income from business and profession. And for this, we have with us a speaker, CMA Amit Sahani sir. CMA Amit Sahani sir is a practicing cost accountant. By qualification, he is BCom, FCA, and CA final. He is a director in Leviare Consultant Private Limited. He is a practicing cost accountant from since 2010 and having a corporate experience of more than 5 years, uh, including at Tata Motors. And he has been very vast experience in teaching field also. He has been in teaching field since more than 21 years. He is visiting faculty at various institute as well as at Pune chapter of cost accountants. He is also a corporate trainer on finance of non-finance direct tax planning, cost audit, Union budget, and he was past secretary of Pune chapter of cost accountant. With his expertise in the income tax, uh, we will very much sure that the participant will get the good knowledge on the various parts of income tax. I welcome Amit Sahaneji for this session and forward sessions. So, without wasting much of time, I request Ms. Sahaneji to take over the session. Amit Sahaneji, over to you.
First of all, thank you very much for inviting me for this session. Special thanks to CMA Shriram Mahakaliwar, Chairman of WRC, Ashish Bhavsar, Vinay Kulkarni sir, and Ashish Tatte sir. Without wasting much of time, I hope my screen is visible and I am audible.
Yes, everything is all
Yes,
right.
sir. Yes, sir.
Okay, thank you.
Yeah.
So today, the topic that we are going to discuss is profits and gains from business and profession. Before I start, I have little poor internet connectivity, so I'll switch off my video so that my audio will be clear. As it is, my face is not that photogenic, so that we'll watch it for 2 hours. Right. So before I start, a few disclaimers. As you all know that if you take any law or any taxation law, there could be several interpretations of that particular law. So whatever I'm going to present it today, these are my opinions because each law is subject to interpretation. So other authors may have some different opinions about it. Then, as you're aware that recently the Union Budget 2023 was presented, and every year this finance bill is presented, which is ultimately converted into a finance act after the consent of the president. And of course, in between there are quite a few notifications and clarifications which are issued, and of course there are High Court judgments, Supreme Court judgments. So provision as it stands today, and wherever possible, whatever budget 2023 has been proposed, those amendments I have tried to include in the today's session also. Third request is many times it so happens that just by attending a session we try to advise someone, but I'll explain it in the subsequent slides also, that mere reading of the provision or mere reading of the single provision may not help you. So whenever you are advising someone, particularly for tax planning or any other matter, so in that case you'll have to also consider the situation and impact of other relevant provisions rather than looking at only standalone provision or standalone section. And of course, all of you are members of the institute, so it is assumed that you know the basic provisions of the act. Of course, I was told that there are a few young members also. So I had tried to make the presentation in such a manner that both senior member as well as those who are new entrant into the profession, both will get benefited. My apology for the senior members if I go too much into some basic concepts, but I think for new entrants, it is very much essential. What is the objective or coverage of today's session? See, as you are aware that profits and gains from business profession is such a vast subject. Just to take one section, like even if we take section 32 of depreciation, the whole 2.5 hours of lecture can be, or 2 hours of lecture can be only on depreciation. So practically, it is not even possible to cover 10% of profits and gains from business profession in a single lecture. But what I will try to do is I will try to make it more relevant. Just to give you an idea that I will be covering section 28 to 44D. Of course, as I said, it is impossible to touch upon each and every section, and that is not relevant also for today's session. I will be also touching upon some of the exemptions as well as deductions. And the basic objective of today's session is I know few of you are already in practice and you are also doing a practice in income tax, but there will be few members who are not doing exclusive practice in income tax, but whenever they assist their clients for any decision making, income tax or tax implication is one of the factors that they need to consider. So today's contents, I have designed it in such a way that it will enable you to get an overview of the whole subject, and which will help you to take the business decision, or whenever you are advising your client, at that time it will be useful for you. So I will try my best. Before we start, just a quick recap of some basic concepts. So as you are aware that there are three concepts: tax planning, tax evasion, and tax avoidance. Tax planning, of course, is a systematic way of saving the tax using the exemptions, deductions, which are available in the Act. And this is a perfect legal way of saving the tax. Tax evasion, on other extreme, is simply suppressing the income or inflating the expenses, not showing the investments. Practically every day nowadays, you hear that ED has let's say had a raid on some builder or some politician or bureaucrats and all that. Similarly, income tax also, you read many times that so and so builder, and typically when it's festival season, so before that all the jewelers, these diamond merchants and all that, they will have typically a raid. So tax evasion is other extreme of it, wherein which is of course an illegal way of uh, tax, or illegal way, I would say. And in between these two comes the tax avoidance. So whenever any section is enacted, or whenever any amendment is done into that, there is some thought process which is behind that particular section or behind that particular amendment. So uh, that is typically called as intent of the law. So many times, of course, these sections or amendments are drafted by human beings. So, as I said at the beginning, there could be two or three interpretations of the same provisions if you give that same section to three different tax experts. So, tax avoidance is between tax planning and tax evasion, but it mainly I would say it is basically an infringement of law of the loopholes of the law. So even in income tax, they have already issued two rules, that is general anti-avoidance rules and specific anti-avoidance rules, just to take care of this third part, that is tax avoidance. So typically when we are talking today, or when we'll be discussing this topic, we are mainly talking about point number one, that is tax planning. Now, as I said, I understand that there are few senior members as well as few new members, or there could be some senior members who are not doing so far practice in income tax, but they want to be a new entrant in the income tax. So for that, whenever a new client approaches to you, so typically there are two possibilities. Number one, he's an existing businessman or is existing person, and or he is having already an established business, and second possibility is it's altogether new business or new venture that he is going to enter into. In both these cases, it is very much important that you should thoroughly understand his business. So understanding the business products and verticals, Of course, being a cost and management accountant, we already know the products, the processes, and all that. But here, the approach should be slightly different. And this is particularly for the taxation as such. As I said, if there is an existing businessman or existing SSE who approaches to you, you should thoroughly check what all exemptions or deductions he is already claiming, right? And you should check on the first part whether those deductions are still valid or whether it is tax beneficial for the SSE. Then, apart from the existing on additional possibilities of any exemptions and deductions, because whenever a client or an SSE approaches to you, or maybe he changes the tax consultant, he will always expect, or the minimum expectations that he will have is you will advise him in such a manner that end of the day you will have some tax saving for him. So you should brainstorm on if there are any additional possibilities of exemptions and deduction, and bottom line should be overall saving in the income tax. Of course, as I said, while doing this, you should have a thorough knowledge and thorough understanding of various sections, that is Income Tax Act 1961, then income tax rules, various notifications, case laws. So all you will have to keep in mind before advising a client for any taxation matter. And it is not a one-time activity. So it's not that you advise someone and then just forget, because as I said, every year union budget is presented and union budget brings in a lot of changes. As Dr. Ashish Tatte was mentioning, old regime and new regime is one of the aspects, but on face of it, you may feel that there were not much of the changes in income tax for this year. But just for your information, there are changes in 122 sections of income tax in this budget. So that gives you a kind of rough idea, because whatever honorable finance minister presents in the parliament is just a summary or just a synopsis of the overall budget. And when actually the budget speech or various notifications and all that, or draft finance bill is received, then we actually come to know what all the actual changes, right? So continuous monitoring is very much required, because as I said, there are various notifications, circulars, then case laws which continuously will require you to monitor your decision or at times change your decision. And last but not the least, and where I personally feel that as a cost accountant we are lagging, is if you get this opportunity, don't forget to formally present this to the client, that what was the tax saving of the overall approach that you have used. So what is the impact analysis that you should show to the client. Now, you may feel that client has given me the assignment and he is least bothered about what I'm doing. Ultimately, he is only interested in saving the tax. And the moment I show, or the moment the tax bill is on a lower side, he is happy. But my sincere request to all is don't do that, because there are two advantages. Number one, he is aware about what you are doing. So suppose tomorrow something goes against it. So as I said, it is a matter of interpretation and this thing. So suppose tomorrow there is a notice, and let's say during the assessment goes against the client, he will of course hold you responsible. And suppose you have not informed him that what exactly you are doing, and that has a negative impact, then the impact will be double. Rather than that, if you inform him that this is what I'm proposing and this will have, or this will overall have will impact on your tax bill, so at least he is informed about what you are doing. So rather than keeping him in dark, it is always advisable that make a formal presentation and show him that this is what was your earlier tax liability, this is what your new tax liability, and this is what is the saving. Or it could be other way around also, because as I said, it's not always necessary that whatever you are advising that will reduce the tax liability, because if any particular tax planning which was done earlier is no longer available, it may even increase the tax liability. But you should be very fair in your approach, and you should be very fair in your presentation to the management. Now, again, coming back to the new client, there are 2-3 points that you should understand, and 2-3 points wherein you can do the value addition for the client. Now, the first one is the location of the undertaking. Now, we'll see it in the subsequent part of our presentation that there are certain specific location specific exemptions. For example, if the undertaking is in SEZ or 100% EOU, then you get certain exemptions. Or if the undertaking is in industrially backward area, then there are certain exemptions which are available. Of course, we'll have a detailed discussion on that. Plus, if you have a specified business, for example, government has their agenda of promoting certain businesses. So let's say 15 years back, if you could see that the number of multiplexes in your area, there were hardly few. But now if you see, the number of multiplexes are increasing, because government wanted to increase the number of multiplexes or 2-star and above hotels and all that. So depending upon the priority of the government, they will give the exemptions to particular class of businesses. So whenever a new client approaches to you, or even the existing client approaches to you, you should have a detailed analysis of the business that he is doing and also the location. Then there are certain specific deductions which are available on the basis of nature of that particular entity. So, for example, tea, coffee, and rubber development or site restoration fund, then all these benefits are for those specific industries. So, again, you should be very clear about his business and what exactly he is doing. And of course, there is a lot of opportunity for restructuring of business also. Of course, if the overall tax impact is to that extent that it may even call for the restructuring of the business also, right? So all these decisions will have to be taken very prudently. Third most important point is, what is the constitution of the business, or what should be the constitution of the business. I will not explain, or I will not go into the details as to what is proprietorship, what is HUF, what is partnership and company. But keep this in mind that if that client has some specific plans in his mind, of course, as I said, once we go to the detailed presentation, I will explain there also that certain exemptions are available for certain constitution of business only. For example, if you want to avail benefit of Startup India, the minimum constitution that you should have is LLP or a private limited company. So if you are having a proprietorship, and even if you have got a very good idea about your goods or services, still you won't be able to get the Startup India advantage. So it's not only important to understand the business as it stands today, but even you will have to ask that client that what are your future plans, and accordingly, either you, if it is a new business, you suggest them the appropriate constitution, or if it is an existing business, but let's say they want to, so let's say there is one existing business, and they want to do some innovation, or they want to do some new they want to work on some new concept. So you will have to check what is the current constitution. So let's say it's a proprietorship, but it is one, they are proposing one innovative product or service. So whether it is really required to formulate or to incorporate LLP or private limited company for this innovation, that also call you will have to take. Because even if that concept is good and it requires certain approvals from the government agencies. So the moment you go for their approval, they will obviously reject that proposal, because for the simple reason that for proprietorship, these exemptions are not available. So depending upon the nature of business or depending upon their future plans, you should guide or you should suggest your client as to what should be the correct constitution. Before we go to the actual topic now, I hope my speed is appropriate and you are able to understand what I'm trying to say. And of course, at the end, we'll have our question and answer session. So whatever doubts that you have, we'll take up at in the question answer session. But so far, so good.
Yes, carry on.
Yes, yeah, thank you. Now we'll move to the, because what I felt was the basic intention of this introduction was to kind of educate those CMAs who intend to be in the practice and who intend to be in the income tax practice, right? So for them, it is very much important. Now we'll see some specific cases. As I said, though section 28 to 44 AD is the coverage, it won't be possible to cover each and every topic and every section and subsection, because we don't have that much time. Plus, it may not be relevant also, because, for example, section 30 and 31 is about the repairs and maintenance of building and plant and machinery. So there is nothing much to explain, or there is nothing much that we can, kind of add a value to that. And that is why I'm just skipping those sections. So it's not that I'm skipping some coverage, but it is not relevant, and that is why I'm just skipping those sections. Again, before we go into the actual sections, a quick recap of basic principles, that the first and foremost thing is business and profession carried on by the SSC during the previous year. That means if it is a company, then the company actually has to start the operations. One more basic thing is, it is very important, which I forgot to mention in the introduction, but it is very much important that what is the meaning, or whatever client has approached you, whether you should classify that client as business or profession. Because there are many case laws on this particular matter, that whether a particular business is, or whether a particular venture is a business or profession. As you are aware, and again we are going to discuss in the latter part, the tax audit limits are different for business and are different for profession. And similarly, there are few sections which are specifically for business, and there are specific sections which are for profession. So again, this is the first and foremost clarity that everyone should have, that whether a particular venture is a business or profession, right? Then again, we should have a clarity about the definition of person in income tax. In income tax, the the category of person, in that the first category is individual. Now, of course, you will be aware of this, but just a quick recap of the basic concepts, that in income tax, there is no concept under the definition of person called as sole proprietorship. So sole proprietorship means individual only, because it's a single PAN that you are using. So even if, say, I have got 5 entities as a proprietorship, and one is a medical shop, one is a cycle shop, one is a hotel, one is a, say, a coffee shop. So even if I am having these different businesses, since all of them are proprietorship, I will have to club the income of all those proprietorship. Similarly, if I'm having a partnership firm, then I will also have to club the income, appropriate income of that partnership firm in the income computation. Then many times legal ownership and beneficial ownership will have to be seen. just to give a simple example, let's say if you are buying a car and today you have purchased a car. Typically, at least in Maharashtra, it is a very common thing that even if you buy a vehicle today, to get the registration certificate and all that takes at least 15 days to 30 days, or typically a month's time. Now, the question arises that as per the RTO records, you are still not the owner. But all the formalities related to transfer have taken place. That means that dealer has accepted your payment, he has handed over you the keys. Now the only problem is, the as per the RTO records, your name is still not appearing in their records. Now the question or the issue arises that you are a legal owner, or rather you are a beneficial owner but not the legal owner. But in this case, there are many case laws on this matter also, that even if you are a beneficial owner, still you will be considered as owner even if the legal ownership comes slightly later. Then real profit versus anticipated profit, there should not be any fictitious entries or fictitious profit that you should book in the books of accounts. We have a basic principle in accounting that all anticipated losses and expenses should be considered, but no anticipated incomes or profit should be considered. So that is a basic accounting principle which same applies over here. Then any recovery of sum which is already allowed as deduction is always taxable. For example, you have written off bad debts, assuming that your customer will not pay, and your luck is too good and that fellow pays you in future. So you have already claimed it as deduction. So subsequently, whenever there will be a recovery, that will be treated as your income in that particular year. Then mode of book entries are not relevant. Now, for example, let's say I'll give you a simple example. Let's say you are running some nursing home or maybe a kind of clinic. Now, for that, you have hired some, say, for example, therapist or some specialized persons. Now, let's say your turnover is 1 crore rupees and you are paying 60 lakh rupees to those therapists or to those experts. Now, in your books of accounts, what you have done is you have netted off this 60 lakh rupees against 1 crore of turnover, and you are showing turnover only as net amount, that is 40 lakh rupees. Now, this is not allowed. So, how you are passing the entries in your books of accounts is not relevant, because ultimately the accounting principles are very much clear, and plus even for many aspects, income tax has already issued income computation and disclosure standards. So accordingly, you will have to show the income appropriately, and in that case, your book entries won't be relevant. And of course, you cannot claim that this is what I have shown and this is what is you should consider. No, that won't happen. And that is precisely the next point, that the onus of proof lies on the assessee. Now, onus of proof lies on the assessee looks to be a simple statement, but it is very dangerous, because those who are in practice will know. Recently, few of my clients received the notice pertaining to assessment year 16, 17, or maybe even older than that. In that, what they have considered is, let's say I have sold a property for 50 lakh rupees, and by selling that property, I have purchased a new property of say 1 crore rupees. So, because of the confidentiality, I will not be able to show that notice. But what income tax has done is, what they have stated is, we have got the information that you have sold one property of 50 lakh rupees and you have purchased a property of 1 crore rupees. So, according to us, your income is 1.5 crore rupees. Right. So, this kind of notices, this is not exaggeration. I have the copy of that notice, and those who are in practice also will know that this kind of notices are being issued by the income tax department. So, once they say that your income is 1.5 crore rupees, and by mistake or by any chance, if you don't reply to that notice and he goes for a base judgment assessment under section 148. That means on 1.5 crore rupees, you will have to pay the tax along with the interest and penalty. And that is why it is very much important that this particular sentence, that onus of proof is on the assessee, that assessee will have to prove that how his income is not 1.5 crore rupees. You cannot just ask income tax department, what rubbish, you tell me how you have worked out 1.5 crore. No, he will say, this is my calculation, you prove that my calculations are wrong. So that is very much serious, and that is why this point is very much relevant. Allowances are cumulative, and the expenditure should have been incurred in connection with assessor's business. Though this is a principle in few sections, uh, though the expenditure is not related with the assessor's business, still you can get uh, a deduction that we'll see at the appropriate thing. But as a principle, the basic principle is expenditure should have been incurred in connection with assessor's business. Then a benefit of expenditure may extend to somebody else. Now, for example, you have taken an insurance premium, and during the year there has not been a single case of any accident or say damage. So ultimately, what has happened is you have paid the premium, but there is no benefit. So ultimately, who got benefited out of it? It is the insurance company. But income tax department cannot say that you have not, or you. It is the insurance company who benefited out of this, and hence we will disallow your insurance premium paid. No, that stand income tax department cannot take. One more important aspect is benefit may extend beyond the relevant previous year. Now, for the classic example is of advertisement. Now, when you do any advertisement, you are aware that the impact of that advertisement may extend beyond one financial year. In olden days, there was a concept called as deferred revenue expenditure. But now this deferred revenue expenditure concept is not there. And typically advertisement. So again, income tax department cannot take a stand that, see, you have done the advertisement, but the benefit of that is getting extended beyond 1 year, and hence we will allow you in installments. No, that cannot happen. There are many examples for this. For example, Cadbury ad. So we still recollect. So the moment we say Cadbury, we all recollect those old ads. So the point is the impact is still there, and but the expenditure was done in only 1 year. Then capital versus revenue expenditure, I did not spend time on this because we are all members and you are already aware about this. And no allowances in respect of non-assessable income. So again, the logic is simple. Whatever assessable income is there, on that the expenses are allowed. But if there is any exempt income, you cannot claim any expenses for that exempt income. Now moving on to the deductions part. Now, I know that this online sessions at times to make it interactive is a bit problem, but let me just ask you one basic and simple question. Having more depreciation is better or having lesser depreciation is better? Either you can unmute yourself and answer, or you can simply put it in the chat box.
More depreciation, correct?
No, according to me, that depends on the other benefits what you are getting. So there are more chapter 6 deduction that you can always claim a lesser depreciation. For example, earlier there was a concept of extra shift allowance. People used to forego extra shift allowance and claim their whatever chapter 6 deductions are there. So one can always take the stand that you can claim 35 2A, that is 32
Correct.
2A.
Let's not go into too much details. Like I appreciate your answer, but the simple answer to this is having more depreciation is better or lower depreciation is better. Having more depreciation is better because we are discussing about income tax. Now, had it been a case of companies that, because if you want to, simply speaking, if you want to show some rosy picture to your shareholders, obviously under Companies Act, you will try to show a lesser depreciation so that your profitability will a higher side. But when it comes to income tax, and fortunately or unfortunately, income tax calculations never goes to the shareholder. More depreciation is always better for the assessee, because ultimately it ends up end up in saving his taxes, right? So rather than looking at depreciation only as one deduction, uh, we should look at it as a kind of incentive for the businessman, right? And as you are aware that the only method of depreciation which is allowed in India is block of assets, right? Now, the critical part in this is choosing the correct block of asset, because again, I did not explain that there are blocks for first two blocks are for building, then furniture, then plant and machinery, and the last one is for intangible assets. And each block has different rate of depreciation. And maximum case laws as far as depreciation is concerned are on this classification, that which or whether to classify a particular asset under which block, right? So whenever you are doing this, you should very much take a caution or with precaution, I would say, to classify that asset into the correct block, right? Otherwise, unnecessarily, you will end up having differential tax and interest and other implications. Then one more simple technique of saving the tax is the timing of the purchase. Typically, if you are planning to buy an asset somewhere in October, then you should advise the client that he should purchase that before. I'll request members to keep you on mute so that there won't be any disturbance here. Thank you. And so let's say a particular client is planning to buy asset in the month of October. Of course, you should also check about the cash flow and other implications. But in this case, you should advise that client that if possible, I'll repeat as again, subject to the cash flow issue and all that. If it is possible to buy it before September, then of course you will get 100% depreciation in the first year itself. Otherwise, you will only get 50% of the eligible depreciation. Then, as you are aware that there is a concept of additional depreciation. Of course, this is only for those who are in production or manufacture or generation, distribution of power and all that, and that too on a specified plant and machinery. Then, in that case, you get 20% depreciation, additional depreciation apart from the regular depreciation. 20% is the additional depreciation in the year in which the additions are done. And if your undertaking is in Andhra Pradesh, Bihar, Telangana, and West Bengal, then you get 35% as the additional depreciation. As the name indicates, it is an additional depreciation, so it is available in the year of addition only. If the asset is put to use for less than 180 days, you can claim 10% in the current year and 10% in the subsequent year. And if it is 35%, then 17.5% in the current year and balance in the next year. Now, while doing this, typical issues which comes is when the specified assets, there's a definition that it should be installed in the factory and not in the office, and it should not be office appliances or office equipments and all that. It has to be a plant and machinery. Now, there are many case laws on this particular matter. For example, say if I purchase, say, air conditioners in bulk. Now, there is one CNC machine in the factory which requires a complete air conditioned atmosphere. So out of those ACs, let's say I have purchased 20 ACs, out of that 4 I have installed in the factory, right? And remaining in the office premises. Now, again, the question arises that whether this AC which is installed is an office appliance or it is a part of plant and machinery. Now, many times the dispute happens on this, and it is always advisable that you take a technical certificate that this particular machine requires 24 hours air conditioned atmosphere, and these ACs are installed in the factory. And of course, if you are having the fixed assets numbering system and all that, you make sure that those ACs will have the location of that particular factory. Because in many cases, whenever someone has claimed additional depreciation, these are typically the dispute points which happens. And whenever after 2-3 years, whenever the query will come to create the documentation after that, rather than, it is always better that you create the documentation there and there itself, so that whenever there will be query in the future, you will be able to explain that query along with the backups, so that there won't be any disallowances. Then again, the typical decisions from a business point of view that we take, that whether to purchase that asset or lease that asset, there are several factors, and one of the factors should be, or one of the considerations should be, the tax implications of those buying versus leasing. So that also you'll have to keep in mind. And the last point about depreciation is, many times while filing the return, if by mistake, if you show the entire business loss under the same line item, then the disadvantage of this is the business loss, pure business loss, has only 8 years of carry forward of loss. And to claim the business loss, it is important to file your return in time, income tax return in time. Whereas unabsorbed depreciation can be carried forward for n number of years, and for claiming this, it is not necessary that the return should be filed in time. But many times, the mistake that is been done by while filing the return is, instead of showing two separate line items like business loss and depreciation, many times this entire business loss is shown as single line item, and if that amount is substantial, then there will be a huge impact on your taxability in the future. So one will have to be very careful while filing the return also about this depreciation. The next one is expenditure on scientific research. In income tax, earlier there was a concept of weighted deduction, but now that weighted deduction concept is almost not there. I'm saying almost. What is weighted deduction? If you spend 100 rupees, either you get a deduction of 125 or 150 rupees, and or in some cases it was even 200 rupees. That is 200% of your expenditure. So revenue expenditure and capital expenditure, which are related to the business of the SSC and specifically for scientific research, then 100% deduction is available. Then even if the expenditure is incurred 3 years prior to the commencement of the business, still you get this exemption. Then if you have got a in-house research and development unit, section 35(2)(ab), so except for land and building, subject to the Department of Scientific and Industrial Research approval, you get 100% deduction. Now the point which I was trying to explain at the time of the basic concepts, that the constitution of the business plays a vital role. Now this particular deduction is available only research oriented or technology oriented, and he wants to claim this particular business. I'm not saying that just to claim this benefit he should float a company, but you should always see the cost benefit analysis, and accordingly we'll have to advise the client whether you should go for a company or other constitution. Right now, this 35(2)(ab) at one point of time was a very popular thing, because there was a weighted deduction of 200% earlier, but now it has come down to 100%. The important point from the consultant point of view is there has to be a separate accounting or separate identification of cost as far as this research and development is concerned. Because let's say if I spend something, for example, let's say if I have this in-house research and development unit, Of course, there are certain restrictions that it has to be fenced, then it has to be demarcated and all that. But let's say I'm having some employees working there, I'm incurring certain overheads. But when I'm doing the accounting, if I have not identified this and if I have not booked this as expenditure related to scientific research, then again, while filing the return or while computing the tax liability, it may happen that you have skipped this and resulting in non-claiming this particular benefit. Even when you are buying some assets, you should again ask the client that what is the purpose of these assets and whether this is for scientific research. And again, it has to be tracked separately. As I said, benefit of weighted deduction is no longer available. And the last point is, even if you are, or rather, even the cases wherein you are donating certain amounts to the scientific associations, approved universities for scientific research or for social and statistical research, then in that case, it is not necessary that the research should be related to your business, but still you get 100% deduction. So again, the point which I'm trying to make is you should be very clear about the provision and accordingly you should guide your client. Next is expenditure on specified businesses. There are certain conditions that the specified businesses should be a new business and not like splitting up or reconstruction of business. Up to 20% of the old machinery is permitted. Second-hand imported machinery is treated as new, and audit of books of accounts is mandatory. Once these basic conditions are satisfied, what is the deduction which is available? 100% of capital expenditure except land, goodwill, and financial instrument, and of course, which is exclusively for the specified business, is allowed as deduction. The only condition is whatever assets that you are claiming deduction, 100% deduction, that should be used at least for 8 years from the acquisition for the specified business, right? So otherwise, the exemption will be revoked. Now, as I said, there are various businesses and various businesses are on the agenda of government, and accordingly they keep on adding various businesses. So at present, the businesses which are available under 35AD are cold chain facility or warehousing facility. This is from 1st of April 2009. Again, specifically, I have added that column for ownership so that you will come to know the importance of constitution. Then cross-country natural gas, crude oil, petroleum pipeline network. Now, again, if you look at this, an Indian company or board or corporation established under a state or central act. So again, if a client approaches to you and he intends to go for this particular business, then you should advise him that if you want to avail this benefit, the minimum that you should have a company. Of course, lining up of pipeline is not a small business and requires huge capital expenditure, and of course OPEX also. So without company, it is practically not possible. But still, a point to be remembered is this is only for company. Then building and operating two-star hotel, two-star and above hotel. Of course, you need a permission from the requisite authority that the hotel is of 2-star and above. Then building a hospital or building and operating an hospital which is 100 bed plus. Then slum rehabilitation or redevelopment housing projects or affordable housing scheme, production of fertilizers, then setting up and operating inland container depot or container freight station, beekeeping and production of honey and bee wax. This is applicable from 1st April 2012. Warehousing facility for sugar, then laying and operating slurry pipeline for transportation of iron ore, then setting and operating a semiconductor wafer fabrication manufacturing unit, and developing and maintaining and operating a new infrastructure facility. Again, this is only for company, and this is comparatively a new addition in the list, which is effective from 1st April 2017. Now, again, the point which I'm trying to explain is you should know the business of the SSC, or you should also understand what are their future plans, and accordingly you will have to advise the client. Now I'll quickly run through some of the other deductions because, as I said, because of limited time, I won't be able to, go into the each and every details of these deductions. But there are nothing much to discuss in this sections. That's what I feel, and that is why I'm just running through these sections. If you do any agricultural extension project, then 100% of such project or expenditure is allowed. As you are aware, that skill development project again is one of the agendas of the current government, and that is why if you do any expenditure on skill development projects, 100% is allowed except land and building. Again, I'll make this point very clear, and maybe at the cost of repetition, I will tell you that this requires a proper accounting, right? So unless there is a proper accounting, these expenses won't be tracked properly. So simple thing is, if you are doing the accounts in Tally, or maybe for that matter any ERP, then you should define this maybe as a cost center, and then whenever you are incurring any expenditure, make sure that the cost center is selected properly and these expenditure are tracked properly. And it has one more, I would say, a word of caution, because all these expenditure are allowed as 100%. So by mistake, if you tag a particular expenditure which is not related with this particular activity of, let's say, agricultural extension project or skill development project, then obviously that will be disallowed, particularly capital expenditure. And in that case, again, there will be a differential tax liability. So you'll have to be very careful about this. Amortization of preliminary expenses, you can do it in 5 equal installments. Amortization of amalgamation demerger, again 5 equal installments. Voluntary retirement scheme expenditure, 5 equal installments. Amortization of expenditure on prospecting for development of certain minerals, it is allowed in 10 years. Family planning expenditure, 5 equal installments. Now, why I'm giving this list is, again, the purpose is, whenever you are doing your tax planning for, say, next 5 years, then again, like we do the projections, or like we do cash flow statement for next 5 years, likewise you also have to do a kind of your tax liability computation for next 5 years, so that the owner or the management will get to know that what is going to be their cash outflow or cash outlay as far as taxation is concerned. And for that, monitoring all these expenses and monitoring this through a proper accounting channel is very much important. Then we'll move to certain specific disallowances. That is, the first allowance is non-deduction or non-payment of TDS. If the payment is made to outside India or to a non-resident, then 100% of such expenditure is disallowed for non-deduction as well as for non-payment. But of course, whenever you comply with the provision, then so if there is a non-deduction case for the current year, but in the subsequent year you deduct that TDS, then in the subsequent year the expenditure is allowed. Similarly, for non-payment, even if you are not paid within the financial year, that is, say, 31st March, but there is an extension given to that if you paid before due date of filing of return, so you have deducted but you have not paid till 31st of March, so there is an extension which is given till due date of filing of return. So even if you paid before due date of filing of return, still it is okay, and you can always claim that expenditure in the current year itself. Of course, for non-resident or payment outside India, it is 100%. But when it comes to resident, then the deduction is restricted only to 30%. The logic is very simple. For non-resident, the traceability is an issue, but if the payment is to a resident person, at least that person is traceable, and therefore, instead of allowing 0%, 70% is allowed and 30% is disallowed. So again, if it is a non-deduction case, then it is not allowed, and it will be allowed in the year in which you deduct that tax. But if it is a non-payment case, then again extension is given up to the due date of filing of return, and post that, if you don't pay, then it will be allowed in the year in which you make the payment. Similarly, equalization levy, particularly for e-commerce transactions, has been introduced. So again, the concept is same. If there is any default in pertaining to non-deduction or non-deposit of equalization levy, then the payment will not be allowed. Then payment to relatives. Now, academically, this looks to be very simple, but practically, to monitor this, so whether you are a consultant, whether you are a CFO, whether you are a tax consultant or a tax advisor, this is a very critical area. And those who are again doing a cost audit, we give a disclosure, but here the responsibility is much more than merely a disclosure. Now, how rigorously or how religiously others or other professionals are doing, I don't want to comment on that. But this is definitely one area wherein a lot of efforts are really required, because there are two things. One, identification of related party, and second, whether it is really disallowed or not. Right? The identification of related party is comparatively an easy task, because the director is supposed to give the declaration, and many times nowadays most of the data is available online. So let's say, even if you go to MCA portal and if you search by the DIN number, you will get to know that that particular person is the director in how many companies, and with search report you will get to know the shareholding and all that. And typically the company secretary will have all this information, because it's a part of their compliances also. The second part is really very important. And why it is important? Because just because you are buying something from a related party, that does not mean that it is disallowed. So there are three aspects. Number one, fair market value of the commodity or service. So let's say, if I'm buying a computer, let's say, just for the sake of example, let's say I am buying a Dell laptop of particular model from the related party. Now, the fair market value of this particular laptop is say 50,000 rupees, and my related party is supplying me at say 65,000. So fair market value is 50,000. He's supplying me at 65,000. So with regards to fair market value, he's supplying me at 15,000 more value. So in this case, only 15,000 will be disallowed. Why? Because considering the fair market value of that particular commodity or service, he has supplied you more. Right? Again, practically, it is very at times difficult to find out this fair market value, because, as I said, theoretically this looks to be very simple. But I'll give you one example. Purpose machine from my related party. Right. So laptop, standard laptop is there. If I put the model, make and model on the internet, I will get the pricing and all that, which is a fairly simple exercise to do. But just imagine a case that I have purchased a machine from my related party, and which is a very special purpose machine, and only my related party is in this particular business. Now, the question arises, there is no comparable product available in the market, then how do I find out the fair market value of that particular commodity? Or again, if you look at, say, service, then if I hire a consultancy of my related party who is having a specialization in a subject, and there is no one with whom I can compare his quotation. So in these cases, it is really very difficult to find out the fair market value of the commodity and services. And in fact, fair market value of the commodity is again one more litigation area, and that actually has lot of issues and lot of litigations have happened because of this fair market value concept. Of course, there are ways and means to find out this, but as it looks simple, it is not that simple in reality, particularly for some specialized commodities and specialized services. Then second is legitimate business needs of the SSE. Now let's take a case of, let's say, a recently passed out cost accountant, and he is having two assistants, and let's say he has started his office. Now his related party is selling a laptop. Now there are only three persons in the office, assuming that there are no laptops presently. But instead of, let's say, buying, so since there are three persons, maximum that he should buy is say three, or at max one spare laptop, so that maximum he should buy 4 laptops. But instead of buying 4 laptops, let's say he has ordered 20 laptops. Okay, the fair market value of those laptops is exactly matching. So let's, the earlier example, 50,000 is the price for that laptop, and he is supplying me at 50,000 rupees also, 50,000 rupees only. So point number 1 is taken care of. The issue is whether it is a legitimate business need of the SSE, because I'm having only 3 persons, so max that I need is 4. Instead, I'm buying 20, so 16 is something extra that I'm buying. Now again, this is a very simple example, but at times it is very difficult to judge whether it is really a legitimate business need of the SSE, right? So therefore, it is again very important that whenever you are buying this, again, the documentation and the accounting part is very much vital in these cases also, right? And the third part is benefit derived by or accruing to the SSE as a result of such expenditure. So fair market value is okay, whether it is a legitimate need of the SSE is also okay. But what is the ultimately benefit that I am deriving out of it? So for example, say if this is a startup business, or let's say I started recently my practice, and I have got 2 assistants, so my accounting apparently is fairly simple. Now I am buying an ERP from my related party. He sells that ERP at 1 lakh rupees. At the same price, he is selling it to me also. So fair market value is not an issue. Whether it is a legitimate business need, yes, because it provides for certain facilities and accounting, of course, and certain other facilities. So whether it is a legitimate business need of the SSE, the answer is preliminary yes. But ultimately, what is the benefit that I am accruing or deriving out of that particular software? Because the scale of operations that I am having today, this software is not at all required, or I'm not getting the benefit because my scale is not that much, and therefore this will be disallowed, or this won't be allowed as deduction, right? So therefore, again, the professional judgment or the professional, you can say, expertise will play a vital role in this related party transactions. Looks to be very simple, three-liner provision, but when it comes to practical aspects or practical, you can say, difficulties, there are too many. And as I said, this is a very good scope for the professionals. And let me make it very clear that whether we are not eligible for doing the tax audit and all that, that is subsidiary thing, I would say. Of course, that is very much important. I'm not denying the importance of that, but there are several other ways wherein we can do a value addition, and these are some of the areas wherein we can really add value, right? I'll not be going to the details as to whom the payment should be made and what is substantial interest and all that. The next, again, per se, very good provision that, in short, anything paid in cash over and above 10,000 rupees, right, is not allowed. Now, you can see even on the screen that it is not covering even 1/4 of the page, right? So the intention of this provision is really very good. But unfortunately, what has happened is, again, I don't want to take a particular name of any profession, but many professionals have made a big joke of this particular provision. Why I'm saying a big joke? Because let's say my client has made a payment of 30,000 rupees in cash, right? So ideally, the professional is supposed to report this in his tax audit report. Of course, if the tax audit is applicable, and he should disallow that expenditure. But rather than doing that, what he does is he do the manipulation in the accounting, and he split that transaction into 3 parts or maybe 4 parts, so that there won't be any disallowance, right? So these are all known facts, so I'm not stating something very which is unknown to you. But the point is, the intention of the provision is really very good, but the kind of I would say negativity which is attached to this provision, and that is why particularly it has killed this particular provision. And more than that, I'll not be going into the each and every exceptions to this. If you look at the exceptions, it runs into 3 pages, right? And again, the professionals will advise the client just to make sure that they are within the purview of the act. For example, one of the conditions says that if you want to make the payment when bank is closed, then you are allowed to make the payment in cash above 10,000 rupees. Now, just imagine a case nowadays, all banks are closed on Sunday. So you have 52 days or 52 Sundays with you. Then on alternate Saturday, that is second, fourth Saturday, normally the banks are closed. So let's assume that half of 52, that is 26 days, are for Saturdays. Then, as per negotiable instruments, negotiable instrument act, at least there are 20 holidays, and so that makes around 98 to 100 days. And plus, there are elections, there are strikes and all that, and so that will add to say few more days, around 15-20 days. So in short, out of 365 days, you have 120 days wherein the banks are closed, and the provision says if you make the payment on these days, then it is allowed as deduction, right? So again, this is being misused by many consultants, professionals, and of course by the businessman. And because of this, of course, government has their agenda of digital currency and all that. But these are all the practical difficulties and issues which are faced by the, even if you want to make it rigorously, or maybe let's say if you want to check particular accounts rigorously, these are the, I would say, the limitation. I'm not saying flaw in the provision, because the provision, there could be some certain serious situations, or there could be some genuine cases wherein you are required to make the payment on holiday or when the bank is closed. But that is very rare case. Majority of the cases are such that these are all manipulated cases. Right. So again, you'll have to be very careful about this. And of course, this is maybe off the record, but many times to retain a client, though this is not ethical, if you advise the client or if you do the computation in such a manner that you disallow all this as per the rule, then obviously next year he's not going to appoint you, which is again a very, I would say, sorry state of affair, that in order to retain the client, we have to bend the law at times and we have to go ahead. Anyways, that is not the topic for today. Then again, if you don't make any certain payments like taxes, then if you make only the provision for bonus and if you don't pay it before the due date and all that, so again, these are not allowed under section 43B. In the recent budget, they have introduced a provision wherein if the payment to SMEs are not made within the stipulated time of 45 days, then that payment will be disallowed under section 43B. So in a way, it's a good thing for SMEs, but for corporates, again, it is a tough job, and they will have to make sure that the compliances are being done. Otherwise, there will be a disallowance under section 43B. So this is a, I mean, though I am not included in the presentation, this is one amendment which has been done in the recent budget. Then last few things, recovery against any deductions, we have seen in the basic concept also. If you have claimed any deduction and there is any recovery against that, then it becomes your income for that particular year. Then sale of asset for scientific research, again, if you sell that asset before the stipulated time, then the exemption starts withdrawn and there are tax implications. Recovery of bad debts, we have already explained. Then amount withdrawn from certain reserves, then that is one part. Second is section 68, 69, 69A and 69B. These are again, as we spoke at the beginning, these are all typical cases of tax evasion. So you have cash credits in your account and for which you don't have any sufficient explanation, then all those cash credits, when I say cash credit, it is not only the cash entries, but of course, whatever is credited in your bank account, and if it is not explainable, then that will be treated as your income. Similarly, if you have got unexplained investments, those also will be treated as your income. Similarly, if you have got unexplained money, the section 69A, again, that will be treated as your income. And if the amount of investment is not fully disclosed or not disclosed in the books of accounts, that also will be treated as your income. So again, a professional judgment will come into play over here. Whenever you do the assessment, and one good part about this is earlier there was no way that we can find out that to cross check what is the assessor's income. Of course, the only way was 26As, wherein it gives a summary of tax which has been deducted. And with a limited exposure or with limited figures, this 26As also used to give certain high value transactions. But now, last November, October, November, they have introduced this annual information statement or taxpayer information statement of your client. Now, when all the banks, financial institutions, and everyone was behind you for comply with the KYC, that is know your customer, and they were asking you for the PAN and Aadhaar. So everyone thought that this is just a formality. But see the linkage. After the KYC was done, each and every or other department was having this entire information with them with a single click. So the moment they put your PAN, they will get all the information. But now the taxpayer has the access for that information, and more than taxpayer, it is very much important for the tax consultants, because we used to send them the mails and we used to take them records and all that. But many times, either intentionally or unintentionally, there was no way wherein we can cross verify whether the information given or the data given is complete or not. But with the introduction of this AIS, TIS, at least we get to know that where all he has bank statement, because bank accounts and all that. Because typically, whenever you will ask for a bank statement, so let's say last year he has given say 10 bank statements. This year he has given only 9. And if you ask him that, अरे ये last year आपने ये दिया था, ये साल आपने वो डेटा में नहीं दिया, नहीं उसमें कुछ transaction नहीं है. But with the introduction of AIS, now everyone gets to know that what is the income in that particular account, or whether there are any significant transactions. And more particularly, this has helped a lot for capital gain, because in the lockdown, a lot of people have started or they have started trading in the shares, mutual funds, and even options and options like derivatives and all that. So whenever we used to, or this will be experience of many of you, that whenever you ask that whether there are any capital gain transactions or capital gain transaction as far as shares and mutual funds, no, there are hardly any transactions, so you can just ignore that. That used to be the answer from the client. But now with this AIS, practically you cannot hide anything. And again, those who are in practice will know that there are many notices which are which have been issued, because if there is a major mismatch between the income as per AIS and as per the return, then they are issuing the notice, and if the explanation is not satisfactory, then they are simply adding that to your income. So again, a word of caution to all the consultants, that before filing the return, you should always see what is there in the AIS. Of course, there is a separate section for taxation of individual. There I'll be elaborating on this. Again, unexplained expenditure, or there is section 69C. Section 43C has been introduced, and wherein computation of cost of acquisition in certain cases is like we have section 50C in capital gain. This 43C has been introduced, wherein cost of acquisition in certain case can be done. And small point about the presumptive taxation. Section 44AD, this is for resident, individual, HUF and partnership firm having turnover up to 2 crore rupees. They can show 8% as the profit. Similarly, professionals, 44 ADA, those who are resident and turnover up to 50 lakh, they can show 50% of profit. Both these turnover limits have been enhanced during the current budget, but I have specifically not included because currently, or let's say in July, we'll be filing return for financial year 22-23. And for that, this budget is of course not relevant. So I don't want to confuse you between the numbers, and that is why I have not included all the amendments in the presentation. But yes, this is a very, I would say, better method of taxation just to reduce the litigations, right? So the only matter of litigation could be the turnover that you have declared. So wherever possible, and that is why I talked at the beginning, that it is important to understand, or it is important to know the definition of business and profession, because under 44 ADA only professionals are allowed, and they can show 50% as the profit. Now, rather than business, many times it is more beneficial. Of course, for business also it is important, but for professionals it is more important because if you have got a smaller setup, then you hardly have any expenses like there could be a rent or salary of 2-3% and all that, which definitely would not cover 50% of your turnover. So in those cases, it is always better to have this approach and go for you can advise your client also, and you can do it for yourself also, to go for 44 ADA, right? And as I said, before doing all this, you should also consider some other sections, like subsequently we are going to see, that is old regime, new regime, and how far it will affect you. And there are certain sections wherein there is no exit, or there are no say once you exit there is a locking period. So all those aspects you'll have to keep in mind before advising a particular client on this, right? So moving on to some of the exemptions under section 10A, this is for free trade zone, that is those who are in those who have set up their businesses in free trade zone, or software technology park, or special economic zone. Then deduction for 10 consecutive assessment years beginning from the assessment year when they actually start manufacturing article or computer software. Of course, some of these benefits are no longer available, so you'll have to be very careful while suggesting this. And of course, the related the compliances which are also required, like attendance and all that. So as you may be aware that those who are working in SEZ, after this work from home or pandemic and all that, they have started asking their employees to come to office or report physically, because there is a requirement. One of the requirements is 50% of the staff should be in the office. So you never know which one will have impact where. So again, you have to be very clear and specific. Then there is a typical method of calculating the exemption, that is profit of the business into export turnover divided by total turnover. As I said, some of these benefits are no longer there, so you'll have to be very careful. Section 10A is similar to this thing, that is special economic zone. I'll quickly run through this. Then there is section 80IA, typically for infrastructure facility, telecommunication, industrial parks, reconstruction of power units, power generation. So up to 100% of profit are allowed for telecommunication for first year it is 100%, from next year it is 30%. Again, I'm just taking this through because just to let you know that there are certain exemptions and deductions which are available under this section. Then 80 ISE, again, very important for the startups. As I said, the minimum requirement is it has to be a LLP or company. And again, many of the businessmen, I'm not talking about the professionals, many of the businessmen feels that startup means today, if I start a company, it becomes a startup company. It is not the case. In order to get the startup status, your product or service has to be innovative, and there is a specific approval from the government agency to qualify you as a startup unit. And of course, there is a turnover limit also, that 100 crores is the turnover limit. So if your if your turnover is exceeding 100 crores, then you will not be able to take the benefit. And it should not be formed by transfer of new business, transfer of business or plant and machinery previously used. So 80 IA, IB, I'll just quickly run through this because not very, of course, I'm not saying not very relevant, but I just wanted to show you this last slide of my presentation. After having discussed all this, and Dr. Ashish Thatte did mention about this at the beginning of the session in his introduction speech, that old regime and new regime, because as you can see it from the speech of Honorable Finance Minister, it appears that very soon they are going to phase out this old regime, and probably from next year only new regime will be there. So while doing all this tax computation and all those things, the last thing, because why I'm saying last thing, because after doing all this, the final thing which comes is the final tax liability. Now, while doing this, you will have to be very careful about applying the old regime or new regime, because if you go for the new regime, then there are certain deductions which are not available. Number one, under section 32 AD is not available. Then 33 AB, 33 ABA, section 35, that is scientific research, 35 AD, exemptions under section 10 A for SEZ units, these are not available. So why I'm specifically giving importance to this particular aspect is, after studying all this or after going through all this, finally, when you compare your tax liability under old regime and new regime, you may find that, or rather, you'll have to judiciously choose which one is more beneficial for you. And as I said, while doing this, you'll also have to understand the implications of this old regime and new regime. Because once you are out of new regime, for next 5 years, you will not be able to opt in. And therefore, you may feel that I had spent much time in the introduction rather than the actual sections. But the intention of that was, whenever I'm repeatedly saying that you should know the business of the SSC, what are his future plans and all that. And this is one of the major aspect now which has come from last couple of years, and it is going to be there for at least a couple of years. And after that, in order to make more easy tax or compliances easy, only new regime will be there, and slowly they will phase out all these exemptions and deductions. But yes, you'll have to be very careful while choosing this option, and this old regime and new regime comparison will also play a substantial role in your overall tax liability, right? So I think this is all from my side as far as the presentation is concerned. I'll be more than happy to take the questions. Of course, I'll try my level best to answer your questions. But of course, if there are too technical questions, I may not be able to give you the answer upfront. But I'll try my level best to answer your questions. So over to you, audience. Again, the objective of today's session was to give you an overview. And as I said, since the topic is really very vast, to go into the intricacies of each and every section and explain you was practically not possible. So rather than that, I chose this particular option that I'll give you an overview, or I'll give you a broad framework of how to approach a client, or maybe if the client has approached you, what should be your thing. I hope it was some value add for you.
So anybody has question? Now the forum is open for question answer.
Sir, we have a sports shop client, and for the sports shop, they do some servicing work for say badminton rackets, stringing of badminton rackets, and cricket bats and all. For that,
Okay.
some machinery is purchased. So we can put it in capital machinery. How do we account for it?
Yes, it's very much. You should capitalize that. Of course, depending upon the materiality of it, I don't know what is the value of those machines, but
they are costly, say, and it is a say lifetime one. You have a machine for long, like bat stringing machine or
right.
racket stringing machine. Yeah.
Yes, so you should very much capitalize those items, and you can claim a depreciation on that.
No, it's a very small this thing. So we are having it. We are on turnover basis only, that presumptive income scheme. So, but just as an accounting this thing, I wanted to get clarification on
So
this.
again, those who are opting for presumptive,
Yeah.
there is always a confusion, or there is always a you can say a question which may come to your mind, that whether we should do the accounting or not.
Yes.
My advice to all of you is you should do the accounting, because as I said, the law keeps on changing. So tomorrow, if they withdraw this presumptive scheme, right? So in that case, it is assumed that whatever depreciation was applicable for that year, you have already claimed that. Or let's say you want to come out of this presumptive scheme. So let's say there is one asset which is purchased 3 years back, and if you have not done the accounting of that particular entity, then what will happen is you will have to do that calculation, or you will have to maintain those books of accounts for last 3 years and arrive at the correct WDV. So rather than doing that, it will and it is always beneficial that you do it in the current year itself, because nobody will be interested in doing last 3 years accounting and see what is the impact on all. So whenever it is fresh, it is always better that you go for it. Second advantage is in some of my clients' cases also, and particularly I'm talking about 44 AD also, that typically we feel that for professionals 50% is a reasonable margin. But in some cases, wherein typically they have their own offices and all that infrastructure, their margins were below 50%. So in that case, that gives you a comparison that if I go for presumptive, what is going to be my tax liability? And if I go for regular books of accounts maintenance, what is going to be my tax liability? But unless and until you do this accounting, you won't be able to do this comparison. So even if you are going for a presumptive, accounting is must.
No, so we are doing accounting in Tally, but and whatever turnover is coming, that only we are showing as presumptive income.
Correct.
So, so that is that. But only because this accounting does not so much matter, this capital or this thing will not affect my turnover. or
Correct,
the
correct,
credit
correct.
and debit or
But that
debtors,
is what I'm saying.
creditors, all
Even
those
if it
things
is,
will not.
it
That
may
is
not
why
matter. It may not
yeah.
matter for the current year, but in
Yes,
the
yes.
subsequent year, if there is any change in
Mm.
law, or if you or if you decide that you will be out of this presumptive, then
Yeah,
this
then
accounting will
it will be
definitely
there.
help you. Yeah, yeah.
And another thing is, sir, this shop is owned by us. So that
Mhm.
shop is actually in the name of proprietor and partner means or family name. So whether that should also be shown in the books of accounts,
It
that is
depends.
not in
Like,
the name of, yeah.
so again, as I explained at the beginning, in
Mm.
income tax, if you see the definition of person, the only definition or the only thing which is included is individual. Now,
Individual, yes.
this is again a typical confusion, or you can say, I would say, choice which
It
is
is a
to
dilemma.
be exercised,
Yeah.
because
Yeah.
there are two things. One is your business assets, and second are your personal assets. Now, the typical question which may come, that whether I should also include my personal assets in the balance sheet of
Mm.
the business.
Yeah, yeah.
Right. So again,
Yes.
there are both the views, because one view is you are maintaining the books of accounts of your business, so personal assets should not form part of it.
Yes.
But typically, I normally advise all my clients that you should also show your personal assets, because unless you do that, accounting for your personal assets and liabilities also won't be there. So how to show
Yeah.
this? Because, so for example, let's say you have got a flat and there is a loan on it. So
Yeah.
whether to show that flat on the asset side and loan on the liabilities side, or
Mm.
under capital account only, you show this flat and the loan, that is a choice that should be exercised. But you should always show this personal assets also in your balance sheet. The manner of presentation can be different.
Okay. Okay. Yes. Thank you, sir. Thank you.
Yeah, thank you. Any other question?
Some question in chat box that index derivatives turnover covered under section 44 AB. Hello, Amit.
Hello. Yeah, yeah.
There are question in chat box that
Okay,
index.
I'm just reading that. Just a second. Yeah. Okay. So again, if I understood your question correctly, you are talking about some investments in derivatives and the accounting of that, or like investment in derivatives is just one part of it. Because see, basically, whenever you are dealing with derivatives or whatever turnover that you are having there, that is treated as your turnover only. So there are two things. One is, let's say, if you're asking for an individual who is not a businessman, but he's dealing in derivatives, so that is treated as your speculative income, and accordingly, we'll have to show that turnover and versus your whatever purchase value is there. And of course, there is also the audit applicable in case it exceeds the threshold limit. Is there any mechanism to know unexplained investment? uh, Partly, yes. As I said, in AIS now you get to know part of it, but again, there is a separate topic, I would say, for presentation, and which is for Benami transactions. So there are many steps which are being taken for controlling these Benami transactions. But typically, at least as a consultant, it is really very difficult to know unexplained investment unless you actually drill down. But again, I don't think that is a scope of any consultant to drill down and check whether he's having any unexplained investments and all that. Then if a proprietor has constructed 3 warehouse facility in 3 different years, how deduction of profit can be claimed under section 80 IA, since 100% deduction is available for 8 years. Can you elaborate your question, please? Like, the last part somehow I'm not able to understand. Like, since 100% deduction is available for 8 years, so 3 warehouses in 3 different years, so 100% deduction is available for each year, because it is a capital expenditure, and the moment you do any capital expenditure, that is allowable in that particular year. I hope I have understood the question and I have clarified it in. Okay, I don't see any other questions in the chat box. If anyone has any other question, I'll be happy to take that. And of course, this was the first, I would say, presentation which I made for this particular kind of crowd. So if some of the expectations are not clear, or maybe you wanted something different, that also you can share with us, so that next time I will definitely improve upon that. Or maybe we have few more sessions also, so maybe those aspects, if you feel that those should be covered in the presentation, maybe in the subsequent sessions also I'll take up those topics or particular sections or any discussion. Anything else, or shall we come to the conclusion?
Anybody has another questions or anything?
Yeah, I just wanted to know that feedback to AIS, if there is any error to AIS,
Yes.
will it be covered during these sessions? I wanted to know. Because that is
not specifically we'll be covering. Maybe it's a good session. Maybe in taxation of individuals, I'll cover that.
Yeah, so because it's important now.
Yeah, sure.
At times it is possible that duplicate entries come from
Correct. There are
bank
several
invoice.
issues in AIS also.
Yeah.
And maybe definitely I'll cover it in the taxation of individuals. Thanks for the suggestion.
Thank you.
Yeah.
Mr. Farooq has raised the hand.
Yeah,
I
only asked
Yes,
the question
yes.
now.
Yeah.
And the
Yes,
other
yes.
thing is, when preparing accounts for sole proprietor, isn't it advisable for him to keep completely separate records for his business and for his personal account, and not to mix up, because there was some mention just now of
Yeah, that's what I'm
balance sheet.
saying. That one is, the question number one is, there has to be accounting of personal assets also. Personal
Separately
assets as
or
well as, that is what I'm coming to. So there has to be accounting for personal assets as well as liabilities. Point number one. Now, second is the presentation of those personal assets and liabilities. So one way of presenting it is, suppose I have purchased a residential house property. So one way of presenting it is, I show that as my asset, and on the liability side, I show the loan amount. That is one way of presentation. Second way of presentation is, if you want purely the business assets and liability should be shown, you can very much take that both the like your asset as well as loan in the capital account. So that at least there will be an accounting of those personal assets and liabilities, and nothing will be skipped out of it. Because I have seen this in many cases, that particularly because of nowadays changing lifestyle and this thing. Unfortunately, it had happened in a few of my clients' cases also that let's say the person who was actually working, only he was knowing his assets, liabilities, and everything. So none of the family members were aware about his family members, and unfortunately, his earlier accountant never did any accounting for his personal assets and liabilities. So once we do that, it's a ready thing. So just to conclude on your question, there has to be an accounting. The manner of presentations can be decided by you.
Okay, thank you.
Yeah. Anything else?
Anybody has any question? It seems that all are okay with income from business and profession now.
Right.
Thank you very much, Amit Saneji, for detailed and elaborate presentation on within the time constraint about the income from business and profession. So now we concluding our second session on the income tax series. I thankful to the Amit Sahani sir for giving this presentation. I'm also thankful to Dr. Ashish Thatte sir and Srimram Mahakaliwal sir for remain present in this session. And we have our next session on 10th of February on income from house property. So and being given by CMA Dakshesh Choksi sir. So we will be back in next week once again on Friday, Saturday at the same time. Thank you very much all for remain present, and Amit Sahni sir for giving the presentation. Thank you.
Thank you, WRC, for giving this opportunity. Thank you.
Yes, yes. Thank you very much.